Before we begin, it's crucial to understand that the information presented in this video is for educational and informational purposes only. It should not be interpreted as financial, investment, legal, or tax advice. Trading foreign exchange on margin carries a high level of risk and may not be suitable for all individuals. The potential for substantial loss exists. Before deciding to trade, you should carefully consider your investment objectives, level of experience, and risk appetite. Please consult with an independent and qualified financial advisor to ensure it aligns with your personal circumstances. We are not financial advisors, and this presentation is not an offer or solicitation to buy or sell any financial instrument. Every single day, a financial tidal wave crashes across the globe. It's a market so massive, it makes Wall Street look like a quiet neighborhood street. We're talking about $7.5 trillion. Not per year, not per month, every single day. That is more money than the New York Stock Exchange, the Tokyo Stock Exchange, and the London Stock Exchange trade combined. And the craziest part? Most Americans have no idea it even exists, even though they interact with it constantly. This is the world of Forex, and the currency at the very center of this global storm is the one in your wallet, the US dollar. Have you ever planned a vacation abroad? Maybe to London or Rome. You check the exchange rate. $1 gets you, say, 92 euro cents. You get busy, forget to exchange your money for a week, and check again. Now, that same dollar gets you 95 euro cents. Your dollar just got stronger. You can now buy more with it. Without lifting a finger, the value of your money changed relative to another currency. You just participated in the foreign exchange market. Now, what if you could understand the forces that cause those changes? What if you could learn to analyze why that shift happened and position yourself to potentially benefit from those movements, big or small? That is the entire purpose of this series. We are going to pull back the curtain on the largest, most liquid financial market on the planet. We're going to demystify it, strip away the confusing jargon, and give you, a regular American, a foundational understanding of how this world works. This isn't about get-rich-quick fantasies. This is about financial literacy. It's about understanding the engine room of the global economy and the immense power the US dollar wields within it. By the end of this series, you won't just hear about a strong dollar or a weak yen on the news and nod along. You will understand what that actually means for your wallet, for the country, and for the world. So let's start with the absolute basics. What is Forex? The term stands for foreign exchange. At its core, it's incredibly simple. It's the market where currencies are traded. That's it. Think of it like a massive 24-hour global currency exchange booth. But instead of trading your dollars for euros for a vacation, institutions, banks, corporations, and individual traders are exchanging currencies for countless reasons. International trade, tourism, economic stabilization, or speculation on future value. If a US company like Apple wants to buy parts from a manufacturer in Japan, they can't pay in dollars. They have to exchange their US dollars for Japanese yen to complete the transaction. When you buy that beautiful German-engineered car, a currency exchange had to happen somewhere down the line. This constant, global dance of exchanging one currency for another is what creates the Forex market. And here's what makes this so directly relevant to you as an American. The US dollar is the undisputed king of this market. It's what's known as the world's primary reserve currency. What does that mean? It means that central banks and major financial institutions all over the world hold a massive amount of their reserves in US dollars. When Brazil sells coffee to Saudi Arabia, they don't price it in Brazilian real or Saudi real. They almost always price it and settle the transaction in US dollars. The dollar is the global standard, the common language of international commerce. Because of this, over 85% of all trades in that $7.5 trillion a day market involve the US dollar on one side of the transaction. Understanding Forex for an American is understanding the global stage on which our own currency is the star player. Now, in this market, you never just buy the euro or sell the yen. Currencies are always traded in pairs. This is a fundamental concept, so let's make it crystal clear. Think about it, to buy something you have to sell something else. If you go to a store and buy a gallon of milk, you are selling your dollars to get that milk. The price is a pair, milk versus dollars. In Forex, it's the exact same principle. You might see a quote like euro to US dollar equals 1.08. This is a currency pair. The euro versus the US dollar. The first currency listed, the euro, is called the base currency. The second one, the USD, is the quote currency. That number 1.08 is the price. It's telling you how many units of the quote currency it takes to buy one single unit of the base currency. So, in this example, it would take $1.08 to buy one single euro. If you believe the euro is going to get stronger against the dollar, you would buy the euro to US dollar pair. In doing so, you are simultaneously buying euros and selling dollars. If you believe the US dollar is going to get stronger against the euro, you would sell the euro to US dollar pair, which means you're selling euros and buying dollars. There are dozens of currency pairs, but you don't need to know all of them. Most of the action happens in a handful of pairs known as the majors. And what do all the major pairs have in common? They all include the US dollar. You have euro to US dollar, the euro versus the dollar. You have US dollar to Japanese yen, the dollar versus the Japanese yen. There's pound sterling to US dollar, the British pound versus the dollar, often called the cable, and others like the US dollar to Swiss franc, and US dollar to Canadian dollar, Canadian dollar. These pairs are the superhighways of the Forex market, with the most traffic or liquidity, which means it's incredibly easy to buy and sell them at any time. This brings us to another unique feature that sets Forex apart from the stock market. You know how the New York Stock Exchange has that famous opening and closing bell? It runs from 9:30 a.m. to 4 p.m. Eastern Time. After that, for the most part, it's closed for business until the next morning. The Forex market doesn't have a closing bell. It doesn't have a central physical location. It's a decentralized global network of banks and financial centers. When the trading day ends in New York, it's just getting started in Tokyo and Sydney. As Asia winds down, the financial centers in Europe, Frankfurt, Zurich, and most importantly London are firing up. And just as Europe is heading for lunch, New York is waking up again. It's a continuous 24-hour cycle, 5 days a week. The sun literally never sets on the Forex market. This global, always-on nature is one of its defining characteristics, offering a level of flexibility that traditional stock market hours simply can't match. So let's recap what we've covered. We've established that Forex is the largest financial market in the world, where currencies are traded. We've learned that for Americans, it's especially relevant because the US dollar is the dominant currency at the heart of this global system. We now understand that currencies are traded in pairs like euro to US dollar, which simply represents the price of one currency in terms of another. And we know that this market operates 24 hours a day, 5 days a week, following the sun around the globe. You now have a better foundational understanding of Forex than 99% of the population. But this is just the first step. This is the 10,000-foot view. To truly understand this world, we need to zoom in. We need to understand how traders measure price movements. How do you quantify a small or a large change in a currency's value? How is it possible to trade with more money than you actually have in your account? And most importantly, how do you even begin to approach this market with a strategy and a plan to manage the inherent risks involved? These are the critical questions we will be answering as we go deeper. In this series, we're going to break down the language of the market, terms like pips and lots. We'll explore the powerful and double-edged sword known as leverage. We will introduce you to the different ways traders analyze the market, from looking at charts to studying economic news. And we will dedicate significant time to the most important topic of all, risk management. We are building your knowledge from the ground up, piece by piece, so that you can look at this complex world with clarity and confidence. Your journey to understanding the global economy's engine room has just begun. So, who are the titans operating this global engine? Who are the drivers, the mechanics, and the fuel suppliers that cause trillions of dollars to change hands every single day? Understanding this is not just trivia, it's fundamental. Because in the world of Forex, you're not trading in a vacuum. You are a small boat in a vast ocean, and your survival and potential success depends on understanding the currents created by the giant vessels around you. Let's start at the very top of the food chain, the central banks. Think of them as the rule makers, the referees of the entire game. For us in the United States, this is the Federal Reserve or the Federal. In Europe, it's the European Central Bank. In Japan, the Bank of Japan. These institutions aren't in the business of making a profit. Their goal is different. They are the guardians of their nation's economic stability. They control interest rates, manage inflation, and can print or remove money from the system. When the chairman of the Fed even hints at raising interest rates, the US dollar can surge or plummet in a matter of seconds. Central banks are the most powerful players because they can fundamentally change the value of their currency on a whim, not for profit, but for national policy. They don't play the game, they set the board. Just below them are the commercial and investment banks. We're talking about the household names: JP Morgan Chase, Goldman Sachs, Deutsche Bank, Citigroup. This is the interbank market, and it is where the vast majority of all Forex trading happens. These banks trade for a few key reasons. First, they facilitate business for their massive multinational clients. When a company like Apple needs to pay its suppliers in China, they don't do the currency exchange themselves. They go through a major bank that handles the transaction, moving billions of dollars from USD to Chinese yuan. Second, they trade for their own accounts, a practice known as proprietary trading. They have teams of analysts and traders whose sole job is to analyze economic trends and speculate on currency movements to generate profit for the bank. These banks are the whales of the Forex ocean. Their trades are so enormous they create the very waves that everyone else tries to ride. Next, we have the multinational corporations themselves. Think of Ford selling cars in Germany, or Coca-Cola selling beverages in Brazil. To operate, pay employees, and repatriate profits, they must constantly convert currencies. A US company earning revenue in euros must eventually convert those euros back into US dollars. While their primary goal isn't to speculate, the sheer volume of their currency needs makes them a major force. If a huge corporation decides to move billions of dollars back to the US before an earnings report, that act alone can cause a noticeable shift in a currency pair's value. They are the constant, predictable currents in the ocean. Then you have the big guns of speculation: hedge funds and investment managers. Unlike corporations who trade out of necessity, these players are in it purely to profit from currency fluctuations. They manage massive pools of money from investors and use highly sophisticated strategies to bet on the direction of currencies. They might analyze that the Australian economy is set to boom due to rising commodity prices and decide to buy billions of Australian dollars, betting it will appreciate against the US dollar. These funds are known for making aggressive, highly leveraged moves that can trigger major market swings. They are the sharks, constantly hunting for opportunities. And finally, there's us, the retail traders. This is the smallest segment of the market, but it's growing exponentially. We are the individuals sitting at home, accessing the global market through an online broker. We don't have the capital to move markets ourselves. Instead, our strategy is to analyze the actions of the bigger players, the central banks, the commercial banks, the corporations, and try to position ourselves to benefit from the movements they create. We are the surfers trying to catch the perfect wave created by the whales. Understanding that you are a surfer, not a whale, is perhaps the single most important mindset shift for a new trader. Now that we know the players, let's talk about the playing field itself, the currency pairs. In Forex, you are never just buying one currency. You are always simultaneously buying one currency while selling another. It's a relative value game. Think of it like a seesaw. If you believe the euro is going to get stronger and the US dollar is going to get weaker, you would buy the euro/USD dollar pair. You're not just betting on the euro to rise, you're betting on it to rise relative to the dollar. This brings us to the most fundamental concept of reading the market, the base and quote currency. When you see a pair like euro to US dollar quoted at 1.0800, it's a simple equation. The first currency listed, the euro, is the base currency. The second one, the USD, is the quote currency. The base currency always has a value of 1. So, in this case, 1 euro is worth 1.0800 US dollars. The easiest way to remember this is to think of it like shopping. The base currency is the item you are buying, 1 unit of it. The quote currency is the price tag. It's how much of the second currency it costs to buy 1 unit of the first. The Forex market is divided into 3 main categories of pairs. First, and most important, are the majors. These are the 7 most traded currency pairs in the world, and they all involve the US dollar on one side of the transaction. They are euro to US dollar to Japanese yen, pound sterling to US dollar to Swiss franc, US dollar to Canadian dollar, Australian dollar to US dollar, and NZD/USD. Why is the US dollar in all of them? Because the USD is the world's primary reserve currency. It's the backbone of global commerce. Most international debts are denominated in dollars, and major commodities like oil are priced in dollars. This makes it the most liquid and heavily traded currency on the planet. These major pairs have nicknames that you'll hear all the time. Euro to US dollar is the fiber. Pound sterling to US dollar is the cable, a throwback to when the exchange rate was transmitted via a transatlantic cable. US dollar to Japanese yen is the ninja. For a beginner, the majors are where you start. They have the most volume, the most data, and generally the lowest transaction costs. Next, you have the minor pairs, also known as cross-currency pairs. These are pairs that feature major world currencies, but don't include the US dollar. Examples would be euro to pound sterling, where you're trading the euro against the British pound, or Australian dollar to Japanese yen, the Australian dollar against the Japanese yen. These pairs can be excellent for finding opportunities when the US economy is quiet, but they often have slightly higher transaction costs and can sometimes be more volatile than the majors because the underlying volume is lower. Finally, we have the exotics. These pairs consist of one major currency traded against the currency of an emerging or smaller economy. Think US dollar to Mexican peso, US dollar versus Mexican peso, or euro/tri-euro versus Turkish lira. These pairs are the Wild West of the Forex market. They can offer potential for dramatic price movements because the underlying economies can be more volatile and susceptible to political or financial shocks. However, this volatility is a double-edged sword. They come with much higher transaction costs and can experience sudden, unpredictable swings. For anyone just starting, it's generally wise to observe the exotics from a safe distance before ever considering trading them. So let's tie it all together. Imagine you hear on the news that the US Federal Reserve, a major player, is signaling a stronger than expected economy and might raise interest rates soon. A large hedge fund, another major player, might interpret this as a sign that the US dollar is about to strengthen. They could decide to sell 1 billion euros and buy the equivalent in US dollars. This massive sell order for the euro to US dollar pair, the playing field, puts downward pressure on its price. As a retail trader, you see this sudden sharp drop. Understanding who is likely behind it and why gives you the context to make a more informed decision, rather than just reacting to a random wiggle on a chart. You're no longer just guessing. You're analyzing the game being played by the giants. You now know who moves the market and the very assets they trade. You're beginning to see the chessboard in 3 dimensions. But knowing the players and the pieces is only half the battle. To truly understand the game, you have to learn how to keep score. You have to learn the language of the market itself. In our next part, we will do exactly that. We're going to decipher the code of Forex quotes, breaking down the critical concepts of pips, lots, and the powerful double-edged sword that every trader must respect: leverage. This is where the abstract world of global economics turns into concrete numbers on your screen. So let's start with the smallest, most fundamental unit of measurement in the Forex world: the pip. The word pip sounds small and insignificant, and in a way it is. But in the world of currency trading, these tiny units are everything. Think of a pip like a single cent in relation to a dollar. It's the smallest standard increment of change. For most currency pairs, like the popular euro versus the US dollar, or euro to US dollar, the pip is the 4th decimal place. Let's make that real. If you see the euro to US dollar quoted at 1.1050, and it moves to 1.1051, that is a 1 pip move. If it drops to 1.1045, that's a 5 pip move down. It's that simple. It's the last big number you see in a standard quote. Now, you might see a 5th smaller number after it. That's called a pipette or a fractional pip, and it's 1/10 of a pip. While it's good to know it exists for understanding the basics, focusing on that 4th decimal place is key. However, there's a crucial exception every American trader needs to know: any pair involving the Japanese yen. Because the yen has a much lower value compared to the dollar, its pricing is different. For pairs like the US dollar versus the Japanese yen, or US dollar to Japanese yen, a pip is the 2nd decimal place. So if US dollar to Japanese yen moves from 130.45 to 130.46, that's a 1 pip move. The 3rd decimal place would be the pipette. Remembering this distinction between yen pairs and all other major pairs is a fundamental rule that will save you a lot of confusion. So pips measure the change in price. But a 1 pip move doesn't tell you anything about the money you've made or lost. A change of 1 cent doesn't matter if you're talking about $1, but it matters a lot if you're talking about $1 million. This is where our second key term comes in: the lot. A lot is simply a unit that measures the size of your trade. It answers the question, how much currency am I actually trading? In Forex, there are standard sizes for these lots, which makes trading uniform across the globe. The biggest and most common is the standard lot. One standard lot is 100,000 units of the base currency. The base currency is the first one listed in the pair. So, if you trade one standard lot of euro to US dollar, you are controlling 100,000 euros. Now, for most people starting out, controlling 100,000 of anything sounds intimidating and requires a lot of capital. And it does. That's why brokers offer smaller lot sizes. The next size down is the mini lot. A mini lot is 10,000 units of the base currency. So, one mini lot of euro to US dollar is a position of 10,000 euros. Going even smaller, we have the micro lot, which is 1,000 units. And some brokers even offer a nano lot, which is just 100 units. These smaller sizes are incredibly important because they allow traders to participate in the market with less capital and manage their risk more precisely. So now we have the two key ingredients, pips which measure the price change and lots which measure the trade size. Let's combine them, because this is where a trader starts to calculate potential profit and loss. The value of a single pip is directly tied to the size of the lot you are trading. Let's use the US dollar as our account currency, as it would be for most of us. For a standard lot of 100,000 units, one pip of movement is generally worth about $10. For a mini lot of 10,000 units, one pip is worth about $1. And for a micro lot of 1,000 units, one pip is worth about 10 cents. Suddenly, the abstract becomes very concrete. Let's say you believe the euro is going to strengthen against the dollar. You decide to buy one mini lot of euro to US dollar. The price moves up in your favor by 20 pips. Since each pip in a mini lot is worth about $1, you would have a potential profit of $20 on that trade. Conversely, if the market moved against you by 20 pips, you'd be looking at a potential loss of $20. See how that works? The pip value, determined by your lot size, translates market movement directly into dollars and cents in your account. This brings us to the elephant in the room, the third and arguably most critical concept, leverage. You might be thinking, how can I, a regular person, control 100,000 euros with just a few $1,000s in my account? The answer is leverage. And it is, without a doubt, the most powerful and the most dangerous tool in a Forex trader's arsenal. Leverage is essentially a loan from your broker. It allows you to open a position that is much larger than the capital you have in your account. It's expressed as a ratio like 50-to-1. In the United States, regulations for retail Forex traders cap leverage at 50-to-1 for major currency pairs. This is a protective measure. In other parts of the world, you might see ratios of 200-to-1 or even 500-to-1. So what does 50-to-1 leverage mean? It means that for every $1 of your own money, your broker allows you to control $50 in the market. The money you put up is called the margin. It's not a fee, it's a good faith deposit that you get back when you close the trade. Let's revisit that standard lot of $100,000. To trade that without leverage, you'd need $100,000. But with 50-to-1 leverage, you only need to put up 1/50th of that amount as margin. That's $2,000. With a $2,000 margin deposit, you can control a $100,000 position. This is what attracts many people to Forex. Leverage magnifies your buying power. It means that even with a relatively small amount of capital, you can take a meaningful position in the market. And here's the upside. It magnifies your potential profits. Remember that 10-pip move on a standard lot that was worth about $100? If you only had to put up $2,000 of margin to make that $100, that represents a 5% return on your capital from a very small market move. That sounds amazing. But here is the part that every single trader must burn into their memory. Leverage is a double-edged sword. It amplifies everything. It amplifies your buying power, it amplifies your potential profits, and just as powerfully, it amplifies your potential losses. That same $100 loss from a 10-pip move against you is also a 5% loss of your $2,000 margin. The market doesn't need to move much to create significant swings in your account equity. This can lead to one of the most feared events for a new trader, the margin call. A margin call is not a polite phone call from your broker asking for more funds. It's an automated action. If a trade goes against you and your account balance falls below a certain required level, the maintenance margin, your broker will automatically and instantly close out your losing positions to protect themselves from you losing more money than you have in your account. This can happen in a flash. A sudden news event can cause a currency pair to spike, and if you are on the wrong side of that move with too much leverage, your position and a huge chunk of your account can be gone before you even have time to react. Understanding this relationship between pips, lots, and leverage is the absolute bedrock of Forex trading. They are not separate concepts. They are a three-part system that defines every single trade. You decide on a trade size, the lot, which dictates the dollar value of each pip. Your broker's leverage determines how much margin you need to put up to control that lot size. The bigger the lot, the more a pip is worth, and the more risk you are taking on, especially with leverage amplifying every tiny move. Getting this balance right, choosing a lot size and leverage level that aligns with your risk tolerance and account size, is the first and most important battle for any aspiring trader. It's the difference between a calculated risk and a reckless gamble. As we move forward, we'll see how traders use this mechanical foundation to actually place orders and interact with the market, but never forget these fundamentals. They are the engine of every trade, determining both the speed at which you can travel and the severity of the crash if you lose control. So now you understand the why, the fundamental economic forces that push and pull these massive currency markets. You have the blueprint, but a blueprint doesn't build a house, and knowing how an engine works doesn't mean you know how to drive the car. It's time to step out of the garage, slide into the driver's seat, and get familiar with the dashboard, because in front of you isn't a simple steering wheel. It's a complex interface of dials and numbers that represent the core mechanics of every single trade you will ever make. These are the non-negotiables, the absolute unshakable building blocks of Forex trading: pips, lots, and leverage. Get these wrong, and it doesn't matter how brilliant your economic analysis is. You're driving with the blindfold on. Let's start with the smallest, most fundamental unit of all, the pip. PIE. It's an acronym that stands for percentage in point, or price interest point. But forget the acronym. What it really means is the smallest possible price move that a currency pair can make. It's the single tick on the speedometer. For most major currency pairs like the euro versus the US dollar, or the British pound versus the US dollar, the pip is the fourth decimal place. So if the euro to US dollar is trading at 1.0755, and it moves to 1.0756, that is a 1 pip move. That last digit, the 5 changing to a 6, that's it. That's the heartbeat of the market. Now you might be thinking, a 10,000th of a dollar? Who on earth cares about such a tiny fraction of a cent? And that is the exact thought that separates a spectator from a trader. You care. You care immensely. Because in the world of Forex, fortunes are built and lost on the accumulation of these tiny movements. Trading is a game of volume. Nobody is trading one single dollar. We're talking about vast sums of money where that fourth decimal place, multiplied by a massive position, suddenly becomes very, very significant. Think of it like a single grain of sand. One grain is meaningless, but a billion grains can form a beach. A pip is that single grain of sand. It's the unit of measurement for your journey. You don't say, I drove a little while. You say, I drove 20 miles. In Forex, you don't say the euro went up a bit. You say the euro to US dollar rallied 80 pips. It's the language of the market, and you need to be fluent. One quick note. For pairs involving the Japanese yen, the pip is the second decimal place, not the fourth, simply because of the yen's much lower value per unit. But the principle is identical. It's the smallest standard tick. So, if a pip is the unit of distance, the next logical question is, how much is that distance worth in cold, hard cash? This brings us to our second core concept, the lot. A lot is simply the size of your trade. It's the amount of currency you are choosing to buy or sell. This is arguably one of the most important decisions you make when you click the button, because it directly determines your risk. It's not how far you drive that matters most, it's the size of the vehicle you're driving. A 10-pip move in a smart car feels very different from a 10-pip move in an 18-wheeler. In Forex, there are 3 main lot sizes you'll encounter. First, the standard lot. This is 100,000 units of the base currency. So, if you're trading the euro to US dollar, one standard lot is a position worth 100,000 euros. With a standard lot, each pip move is worth approximately 10 US dollars. So if you buy the euro and it goes up by 10 pips, you've made about $100. If it goes down by 10 pips, you've lost about $100. This is the 18-wheeler. It moves with power, and the financial consequences, both good and bad, are significant. For those not ready to command a vehicle that large, there's the mini lot. A mini lot is 1/10 the size of a standard lot, or 10,000 units of the base currency. In our euro to US dollar example, with a mini lot, each pip of movement is now worth about $1. That same 10-pip move that was worth $100 with a standard lot is now worth just $10. It's a more manageable size, like a family sedan. The potential for massive gains is reduced, but critically so is the potential for massive account-crippling losses. Finally, we have the micro lot. This is the perfect place for beginners to get a feel for the road. A micro lot is 1/10 of a mini lot, or 1,000 units of the base currency. Here, each pip is worth about 10 cents. That same 10-pip move now results in a gain or loss of just $1. It's the smart car of Forex trading. It allows you to navigate the live market, experience real price movements, and feel the psychological pressures of having real money on the line, but with a level of risk that is substantially lower. Understanding which lot size is appropriate for your account balance and risk tolerance is the foundation of money management. Choosing too large a lot size is like trying to enter a go-kart race with a monster truck. It's reckless and bound to end in disaster. So we have our unit of measurement, the pip. We have the size of our vehicle, the lot. Now we need to talk about the engine, specifically the turbocharger. This is the third and most misunderstood concept. Leverage. Leverage is a tool offered by brokers that allows you to control a large position in the market with a much smaller amount of your own capital. It's expressed as a ratio like 50-1 or 100-1. A 50-1 leverage ratio means that for every $1 you put up from your own account, your broker lets you control $50 in the market. Let's make this real. Imagine you want to trade one mini lot of euro to US dollar, which is a 10,000 euro position. At an exchange rate of say 1.08, that position is worth $10,800. Now, most people don't have a spare $10,800 to place on a single trade. But with 50-1 leverage, you would only need to put up 1/50th of that amount from your account. Your broker requires you to set aside a good faith deposit called margin. In this case, you'd only need about $216 of your own money to control that full $10,800 position. On the surface, this sounds incredible. It's like a bank giving you a massive loan with no interest to invest with. It allows traders with smaller accounts to take meaningful positions in the market. It is the tool that makes Forex accessible to retail traders. It's the turbocharger that can take a small engine and produce breathtaking acceleration. But here is the critical part, the part that you must burn into your brain. A turbocharger works in both directions. It amplifies everything. Leverage amplifies your potential profits, yes, but it also amplifies your potential losses at the exact same rate. If you control that $10,800 position with just $216 of your own money, and the trade moves in your favor by 1%, you've made a profit of $108. On your $216 margin, that's a staggering 50% return. That's the allure. But if the trade moves against you by 1%, you've lost $108. That's a 50% loss of your deposited margin on that trade. If it moves against you by 2%, you've lost $216. Your entire margin for that trade is wiped out, and the broker will automatically close your position in what's called a margin call. Leverage is a double-edged sword with no handle. It must be treated with the utmost respect. It is not free money. It is a powerful tool that, when misused, is the single fastest way for a new trader to destroy their account. Many experienced traders advocate for using the lowest possible leverage, treating it as a capital efficiency tool rather than a way to chase unrealistic profits. They understand that slow and steady growth is infinitely better than a wild, high-leverage ride that ends in a fiery crash. So let's put it all together. You, the trader, decide on a currency pair based on your fundamental analysis, the engine. You then decide on the direction. Then you choose your lot size, the size of your vehicle, based on your account size and how much you're willing to risk. A micro lot might mean you're risking 10 cents per pip. A standard lot, $10 per pip. The leverage provided by your broker allows you to control that lot size with a smaller margin deposit. The market then moves a certain number of pips. The number of pips, multiplied by the dollar value of your chosen lot size, determines your profit or loss. These three elements, pips, lots, and leverage, are interconnected. They are the physics of the trading world. You can't ignore them and you can't cheat them. You can only understand them, respect them, and use them to navigate the market with precision and control. Now that you have the mechanical knowledge of how a trade is constructed, how its size is determined, and how its profit and loss are calculated, it's time to get your hands dirty. We've looked at the dashboard, we understand the dials. The next step is to actually turn the key, put the car in gear, and press the accelerator. We need to talk about the different ways you actually tell your broker, I want in, or I want out. This is the world of orders, market orders, limit orders, stop-loss orders, the actual commands that bring your trading ideas to life. This is where the rubber finally meets the road. So let's start with the most basic command of all, the market order. Think of a market order as the big green go button. When you place a market order to buy or sell, you are telling your broker, I don't care about the exact price, just get me into this trade right now at the best available price. It's like walking into a grocery store, grabbing a gallon of milk, and taking it to the checkout. You're not trying to haggle. you're just paying whatever the price is at that exact moment. The huge advantage of a market order is that your entry is virtually guaranteed. You click the button and you're in the market. This is crucial when a currency pair is moving fast, and you believe you need to act immediately. But there's a potential downside. A hidden ghost in the machine called slippage. Slippage is the small difference between the price you expected to get when you click the button and the price you actually got. In a calm market, this might be a fraction of a pip, almost nothing. But imagine a huge economic news announcement just hit. The market goes wild, prices are jumping around like a pogo stick on a trampoline. You hit buy at 1.0850, but in the split second it takes for your order to travel through the internet and hit the broker's server, the best available price is now 1.0852. That 2 pip difference is slippage. You still got in, but at a slightly worse price than you intended. It's the trading equivalent of trying to buy a hot concert ticket online the second they go on sale. You see the price, you click buy, and by the time the page loads, the system gives you a seat that's a few rows back from what you thought you were getting. For this reason, many experienced traders use market orders sparingly, preferring a tool that gives them more control. That tool is the limit order. If a market order is about speed, a limit order is all about price. A limit order is your way of telling the market, this is my price. I will not buy for a penny more, and I will not sell for a penny less. Take it or leave it. You become the price setter, not the price taker. Let's break this down. There are 2 types. A buy limit order is placed below the current market price. Let's say the euro is trading at $1.10. You've done your analysis and you think, I like the euro, but it's a bit expensive right now. I believe it's going to dip down to $1.09 before it goes higher. So you place a buy limit order at 1.0900. You can now walk away from your computer. If and when the market price drops to your level, your order will automatically trigger, and you'll be entered into a buy trade at 1.0900, or an even better price if one is available. The key benefit? You get the exact price you want. The risk? The market might never drop to your price. It could just keep going up from 1.1000, and you'll be left on the sidelines watching the trade you wanted happen without you. The flip side is a sell limit order, which is placed above the current market price. You might be holding a position, or you might want to initiate a short sell. You think, the market's going up, but I believe it's going to hit a ceiling at 1.1100 and then fall. So you place a sell limit order at that level. If the price rises and touches 1.1100, your order to sell is executed. Again, you get your price or better, but you risk the market never reaching that high and falling from its current level, leaving you out of the trade. Think of limit orders like placing a specific bid on eBay. You've decided the maximum you're willing to pay for an item. If the bidding goes past your limit, you don't get it. But if it stays at or below your bid, you win the auction at the price you were comfortable with. It's a game of patience and precision. Now we arrive at the most important order type of all. If you remember nothing else from this section, remember this. This is the order that separates disciplined traders from gamblers. It's the order that can help manage your account and your emotions. We're talking about the stop order, specifically the stop loss order. A stop loss is your predefined exit plan for when a trade goes against you. It is your non-negotiable line in the sand. It is your financial seatbelt. When you enter a trade, you attach a stop loss order at a price that represents the maximum amount of money you are willing to risk on that single idea. For example, if you buy the euro to US dollar at 1.1000, you might place a stop loss at 1.0950. This means if the market turns against you and the price drops to 1.0950, your broker will automatically close your trade for a 50 pip loss. You've defined your risk up front. You've accepted it. You've made it mechanical. Without a stop loss, you're flying blind. When the trade goes against you, you're left to your own emotions. Maybe it'll turn around, you'll say. I'll just wait a little longer. This is how small losses turn into catastrophic, account-ending losses. The stop loss removes that destructive emotional decision-making from the equation. It's the eject button in your fighter jet. You hope you never have to use it, but you're sure glad it's there. It allows you to take a small, calculated loss and live to trade another day. Every single professional trading plan in the world is built on the foundation of consistently using a stop loss. There's another type of stop order, often called a stop entry order, which is used to get into a trade. This might seem counterintuitive at first. Why would you want to buy at a price that's higher than the current price, or sell at a price that's lower? The answer is momentum. Traders use stop entry orders to catch breakouts. Imagine a currency pair has been stuck in a range, bouncing between a support level at 1.2000 and a resistance level at 1.2100. A breakout trader might believe that if the price can just push above that 1.2100 resistance, it will trigger a flood of new buying and the price will surge higher. So they place a buy stop order at 1.2101. They're not trying to predict the breakout, they're waiting for the market to prove it. If the price breaks that level, their order is triggered, and they're in the trade, hopefully riding the wave of momentum. It's like waiting for a train to start pulling out of the station before you jump on, rather than sitting in a stationary car guessing when it might leave. So how do these all work together? This is where a vague idea transforms into a concrete trading plan. A professional approach might look like this. A trader identifies a potential trade. They decide to use a buy limit order to enter the trade at a favorable price they've analyzed. The moment that limit order is filled and they are in the trade, they have two other orders already waiting in the system. First, a stop-loss order placed below their entry price, defining their exact risk. Second, a limit order placed above their entry, which now acts as a take-profit order. This order will automatically close their trade and lock in their profits if the price reaches their target. Look at the beauty of that structure. Before the trade is even active, the trader has defined their ideal entry, their absolute maximum loss, and their desired profit target. The entire life cycle of the trade is planned. There's no guesswork, no panic, no emotional decisions in the heat of the moment. The plan is set, and the orders execute that plan mechanically. This is the difference between reacting to the market and having a proactive strategy. You've told your broker not just how to get you in, but how to get you out, for better or for worse. You've built a complete system of commands that manages the trade for you. Now that you know how to speak the language of the market, it's time to learn what to say. It's time to learn how to read the charts and the news to form your own trading ideas. That's where we're going next, into the world of charts, patterns, and indicators. Let's start with the charts themselves. If the Forex market is a giant global conversation, then the charts are the transcript. They are the unfiltered minute-by-minute record of every transaction, every hope, every fear. The art and science of reading these charts is called technical analysis. Now that sounds complicated, but the core idea is simple. Many traders believe that all known information, from economic reports to political news, is already reflected in the price. So, by studying the price action, the wiggles and spikes on the chart, we might be able to identify patterns and probabilities about where the price could go next. It's not a crystal ball. Let's be very clear about that. It's about analyzing historical price behavior to identify potential outcomes. It's like being a weather forecaster. You're looking at past storm patterns to assess the likelihood of rain tomorrow, not guaranteeing it. When you first open a trading platform, you'll be faced with a screen of flashing lights and lines. It can feel overwhelming, but really, it all boils down to three main ways of visualizing price. First, you have the line chart. This is the simplest of all. It just connects the closing price from one period to the next. If you're looking at a daily chart, it connects today's closing price to yesterday's and so on. It's great for getting a quick, clean look at the overall trend, like seeing the shape of a mountain range from a distance. You see the big picture, but you miss the details of the journey. For more detail, traders often look at a bar chart. Each bar represents a single time period, an hour, a day, whatever you choose, and it gives you four key pieces of information. This is often called an OHLC chart, for open, high, low, and close. The very top of the bar is the highest price reached during that period. The very bottom is the lowest price. A little horizontal tick on the left side of the bar shows the price where the period opened, and a tick on the right shows where it closed. It's like a mini story of that time period, packed with much more data than a simple line chart. But the chart type that has become the favorite for most traders around the world is the Japanese candlestick chart. It shows the exact same four pieces of information as a bar chart, the open, high, low, and close, but it does so in a way that's incredibly visual and intuitive. Each candle has a wide part called the real body, and thin lines sticking out the top and bottom, called wicks or shadows. The body tells you the story between the opening and closing price. In the US, if the body is green, it typically means the price closed higher than it opened for that period. The buyers were in control. If it's red, the price closed lower than it opened. The sellers won that session. The wicks show you the absolute highest and lowest prices reached during that period, the extremes of the battle. What makes candlesticks so powerful is that they visually represent the psychology of the market, the battle between buyers and sellers. A long green candle with small wicks suggests strong, confident buying pressure. A long red candle suggests dominant selling. A candle with long wicks on both ends and a small body suggests indecision, a real tug-of-war where neither side could claim a decisive victory. Learning to read these individual candles and the patterns they form when grouped together is a foundational skill in technical analysis. Now, a critical concept to grasp is that all these charts can be viewed across different time frames. You could be looking at a 1-minute chart, a 15-minute chart, an hourly chart, a 4-hour chart, a daily chart, or even a weekly or monthly chart. Each candle or bar on that chart represents that specific amount of time. A day trader who aims to enter and exit trades within the same day might focus on the 5-minute and 15-minute charts. They're analyzing very short-term movements. A swing trader who might hold a position for a few days or weeks is more likely to use a 4-hour or daily chart to form their trading ideas. The fascinating part is that a currency pair that looks like it's in a strong uptrend on a daily chart might be in a temporary downtrend on a 15-minute chart. This is why understanding multiple timeframes is so important to many analysts. It's like using both a satellite map and a street-level map to navigate a city. You need the big-picture context and the fine-detail view to understand where you are. So we have our charts, we've picked a time frame. What are we actually looking for? The single most important concept in technical analysis is the trend. There's an old saying in financial circles: the trend is your friend. The idea is that it's often a higher probability path to trade with the market's overall momentum than against it. There are generally 3 types of trends. An uptrend is characterized by a series of higher highs and higher lows. Imagine a ball bouncing up a flight of stairs. Each bounce reaches a higher point, and each landing spot is higher than the last. A downtrend is the opposite, a series of lower highs and lower lows. The ball is bouncing down the stairs. And finally, you have a sideways market, also called a range-bound or consolidating market. Here, the price is just bouncing back and forth between 2 levels like a tennis ball being hit back and forth over a net, with no clear winner. Identifying the prevailing trend on your chosen time frame is often considered the very first step of any technical analysis. If the trend tells you the general direction of the market, the next things to find are the key levels that might halt or reverse that trend. These are called support and resistance. Think of them as invisible floors and ceilings on your chart, drawn based on historical price action. Support is a price level where buying pressure has historically been strong enough to overcome selling pressure, causing the price to bounce back up. It's a floor. When the price is falling and approaches a support level, many traders will be watching to see if it holds. Will the buyers step in again like they have in the past? Resistance is the opposite. It's a price ceiling where selling pressure has historically overwhelmed buying pressure, pushing the price back down. When the price is rising towards a resistance level, the question on many traders' minds is whether the sellers will show up in force again. These levels are formed because markets have memory. If the euro to US dollar pair bounced hard off the 1.0800 level 3 times in the past, traders remember that. They see it as a significant level. The next time price approaches 1.0800, they anticipate a reaction. And because so many people are watching and acting on these same levels, this can sometimes become a self-fulfilling prophecy. One of the most powerful concepts related to this is the idea that old resistance can become new support, and vice versa. Imagine the price is in a range, hitting its head on a resistance ceiling over and over. If it finally decisively breaks through that ceiling, that old ceiling can often become the new floor, the new support level for the next move up. The psychology of the level flips. The price that was once seen by many as a good place to sell is now viewed by many as a good place to buy on a pullback. Understanding these core elements, chart types, time frames, trends, support, and resistance, is like learning the grammar of the market's language. You can now look at a blank chart and start to map out its structure to see the story it's telling. You can identify the major trend and mark out the key battlegrounds where buyers and sellers are likely to clash. But this is just the skeleton. To truly bring our analysis to life, we need more tools. We need ways to measure momentum, to help confirm trends, and to spot potential reversal signals with more clarity. This is where technical indicators and chart patterns come into play. They are the instruments we lay on top of our chart to add layers of depth and confirmation to our trading ideas. And that's exactly where we're headed in the next part. Think of technical indicators as the specialized gadgets in a detective's toolkit. A detective arrives at a crime scene, the price chart, and while they can see the obvious details with their own eyes, They use tools like fingerprint dust, magnifying glasses, and blacklights to reveal hidden clues. Indicators do the same for a trader. They are mathematical calculations based on price, volume, or open interest, displayed graphically on a chart to help traders identify signals and trends. The most important thing to understand is that indicators are reactive, not predictive. They are lagging, meaning they show you what has already happened, just presented in a different way. They don't have a crystal ball. Their power comes from helping you organize the chaos of price action, spot conditions that have historically led to certain outcomes, and build a more objective, rules-based approach to your trading. Let's start with the most fundamental and widely used category: trend indicators, specifically moving averages. Imagine you're driving on a really bumpy road. It's hard to tell if you're generally going uphill, downhill, or staying flat because of all the little jolts and dips. A moving average is like a sophisticated suspension system that smooths out that bumpy ride. It calculates the average price of a currency pair over a specific number of periods, say the last 50 days, and plots it as a single flowing line on your chart. By smoothing out the day-to-day price noise, a moving average gives you a much clearer picture of the underlying trend. If the price is consistently trading above a rising moving average, it's a strong visual clue that the market is in an uptrend. If it's trading below a falling moving average, the market is likely in a downtrend. There are two main types you'll hear about. The simple moving average, or SMA, gives equal weight to all the prices in its calculation period. The exponential moving average, or EMA, gives more weight to the most recent prices, making it react a little faster to new information. Neither is inherently better. They just tell slightly different stories. Many traders use both, often looking for crossovers. A classic signal that many analysts watch for is when a shorter-term moving average, like the 50-day, crosses above a longer-term one, like the 200-day. This is often referred to as a golden cross, and is historically viewed as a bullish signal. Conversely, when the 50-day crosses below the 200-day, it's known as a death cross, which analysts often interpret as a bearish signal. Again, these are not guarantees, but historical patterns that traders use to gauge market sentiment. Now, while moving averages help us see the trend's direction, they don't tell us much about its strength or momentum. Is the trend running out of steam? Is it just getting started? For that, we turn to another class of indicators called oscillators. The most famous of these is the Relative Strength Index, or RSI. If a moving average is your car's GPS showing you the direction of the road, the RSI is your tachometer. Tells you how fast the engine is revving. The RSI measures the speed and magnitude of recent price changes to evaluate overbought or oversold conditions. It's plotted as an oscillator, a line graph that moves between two extremes, typically 0 and 100. Traders pay close attention to two key levels on the RSI, 70 and 30. A reading above 70 is traditionally considered to be in overbought territory. This doesn't mean you should immediately sell. It's more like the tachometer needle is in the red zone. It suggests that buyers have been pushing the price up very aggressively, and the rally might be getting exhausted or overextended. It's a warning sign to be cautious. Conversely, a reading below 30 is considered oversold. The needle is near 0. This suggests that sellers have been in dominant control, and the downward momentum might be losing steam. It could suggest that a bounce or a reversal is becoming more probable. The RSI is a momentum gauge. It helps you understand the psychology of the market. Is it euphoric and overbought? Or is it panicking and oversold? A third, incredibly popular indicator sort of combines the ideas of trend and momentum. It's called the Moving Average Convergence Divergence, or MACD. Don't let the name intimidate you. At its core, the MACD takes two trend-following moving averages and turns them into a momentum oscillator. It's composed of three elements: the MACD line, the signal line, and a histogram. The simplest way traders use the MACD is by watching for crossovers. When the MACD line crosses above the signal line, it's often seen as a bullish signal, suggesting that momentum is shifting to the upside. When it crosses below, it's viewed as a bearish signal. The histogram is a simple visual aid for this. It represents the distance between the MACD and signal lines. When the histogram is above 0 and growing, bullish momentum is increasing. When it's below 0 and growing more negative, bearish momentum is building. The MACD helps traders see potential shifts in a trend's momentum, often before they are obvious from price alone. Now, a critical word of caution. When new traders discover indicators, they often fall into a trap called analysis paralysis. They plaster their charts with a dozen different indicators: RSI, MACD, stochastics, Bollinger Bands, all flashing different signals. Their chart looks like a Jackson Pollock painting, and they're completely frozen, unable to make a decision. Remember, less is more. The goal is to find one or two indicators that complement your style and help you understand price action, not replace it. Price is king. Indicators are just the royal court of advisors. While indicators are mathematical, there's another side to technical analysis that is more artistic and psychological: chart patterns. These are recurring formations created by the movement of price on a chart. For decades, traders have observed that certain patterns tend to precede specific market outcomes. Why? Because they are visual representations of the battle between buyers and sellers. Human psychology doesn't change much over time, so these patterns, reflecting fear and greed, tend to repeat. Let's look at a few classics. The head and shoulders is one of the most reliable trend reversal patterns. In an uptrend, the price makes a peak, the left shoulder, pulls back, then makes an even higher peak, the head, pulls back again, and then makes a final lower peak, the right shoulder. These three peaks are connected by a support level called the neckline. A break below this neckline is seen by many analysts as a strong signal that the uptrend is over and a new downtrend is beginning. It visually shows that the buyers tried to push the price higher 3 times, but their strength waned on the final attempt, and the sellers finally took control. A simpler reversal pattern is the double top or double bottom. A double top looks like the letter M. The price rises to a resistance level, pulls back, and then rallies back to that same resistance level but fails to break through. This failure to make a new high suggests that the buyers have run out of steam, and a reversal lower could be on the horizon. The double bottom is the opposite, looking like a W. It's a bullish reversal pattern that forms after a downtrend. Not all patterns signal a reversal. Some signal that the trend is just taking a breather before continuing. These are called continuation patterns, and the most common are triangles. An ascending triangle, for example, has a horizontal resistance line at the top and a rising trend line of support at the bottom. This pattern suggests that while sellers are holding firm at a certain price, buyers are becoming increasingly aggressive, making higher lows. A breakout above the top resistance line often suggests the original uptrend is about to resume with force. Understanding indicators and patterns adds a profound new dimension to reading a chart. You're no longer just looking at a squiggly line. You're interpreting a story of supply and demand, fear and greed. You're using tools to measure the trend's health, its momentum, and looking for classic formations that hint at what the crowd might do next. But having all these tools, candlesticks, support and resistance, indicators and patterns, is like having a garage full of the best automotive equipment. It's impressive, but it's useless without a blueprint. You need a plan, a strategy that tells you exactly which tools to use, when to enter a trade, where to place your stop loss, when to take profits, and how to manage your capital. And that blueprint, the very architecture of a successful trading approach, is the cornerstone of our next discussion: building your personal trading plan. A trading plan is not a suggestion. It is not a list of vague ideas. It is your personal constitution, the bedrock of your entire trading operation. Think of it this way: a pilot would never take off without a flight plan. A surgeon wouldn't enter an operating room without a surgical plan. And a professional trader would never, ever place a single dollar at risk without a trading plan. It is the single most important document you will ever create in your trading career. It's not just a set of guidelines, it's a legally binding contract with yourself, a business plan for your trading enterprise, designed to do one thing above all else: protect you from your own worst enemy, your emotions. So, what goes into this critical document? Let's build one piece by piece. First, you must define your motivation and goals. This might sound like fluffy self-help talk, but it's the fuel that will get you through the inevitable tough times. Ask yourself, why am I doing this? Is it to generate a secondary income stream? To save for a down payment on a house? Is it the intellectual challenge of cracking the market's code? Be specific. I want to make money is not a goal, it's a wish. My goal is to achieve an average monthly return of 3% on my capital, while never risking more than 5% of my total account in a single week. Now that is a measurable, professional goal. Write it down. This is your North Star. When you face a losing streak, and you will, this is what you'll read to remind yourself why you're putting in the work. Second, and arguably most important, is your risk management protocol. This is where you decide, in the cold, hard light of day, how much you are willing to lose. Not how much you hope to win, but what your absolute unbreakable loss limits are. Many seasoned traders follow what's often called the 1% rule. This means they will not risk more than 1% of their total account balance on any single trade. If you have a $10,000 account, your maximum risk on one trade is $100. Period. This rule is designed to ensure that a string of losses, which is a statistical certainty, doesn't wipe you out. Keeps you in the game. Your plan must also define your maximum daily loss. Maybe it's 3%. If you hit that limit, you are done for the day. You close your platform and walk away. No revenge trading. No trying to win it back. The market will be there tomorrow. Your job is to make sure your capital is too. Third, you must explicitly state your trading style and the strategy you will employ. Are you a scalper looking for tiny profits dozens of times a day? A day trader, closing all positions before the market closes? A swing trader holding positions for several days or weeks to capture a larger market move? Or a position trader with a time frame of months or even years? There's no right answer, but you must choose one that fits your personality and schedule. Then you detail the specific strategy. For example, I am a swing trader. My strategy is to identify trends on the 4-hour chart, using the 50 and 200 period exponential moving averages. I will only take long trades when the 50 is above the 200, and short trades when it is below. This is the kind of mechanical, rules-based thinking that trading requires. Fourth, define your universe. What are you going to trade? The Forex market offers dozens and dozens of currency pairs. A common mistake for new traders is to jump around looking for action wherever it might be. This is a recipe for confusion. Most successful traders are specialists. They focus on a small handful of pairs, maybe 2 or 3. They learn their personalities, their typical daily ranges, how they react to news from the US Federal Reserve or the European Central Bank. For an American trader starting out, focusing on the major pairs like the euro versus the US dollar, the British pound versus the US dollar, or the US dollar versus the Japanese yen is often a prudent path. They offer high liquidity and generally lower transaction costs. Pick your pairs and write them into your plan. If a setup appears on a pair that isn't on your list, you ignore it. Fifth, we get to the heart of the operation. Your entry and exit criteria. These must be crystal clear with zero ambiguity. When exactly do you enter a trade? What specific conditions must be met? This is not about a gut feeling. It's about a checklist. Your plan might say, entry condition. I will enter a long trade only after the price pulls back to the 50-period moving average and prints a bullish engulfing candlestick pattern. All 3 of these conditions must be met. That's a rule. It's testable. It's repeatable. Just as important are your exit rules. Every trade must have 2 predetermined exits. The first is your stop loss. This is the price at which you admit you were wrong and exit the trade to cap your losses. It is non-negotiable. Your plan must specify exactly where it goes. For example, my stop loss will be placed 5 pips below the low of the entry candlestick. The second exit is your take profit target. Where will you exit if the trade goes in your favor? A common approach is to use a fixed risk-to-reward ratio. For every $1 you risk, you aim to make 2 or 3. So your plan could state, my take profit target will be set at a distance equal to twice my stop loss distance. These rules for entry, stop loss, and take profit form the tactical engine of your trading. They remove guesswork and emotion when your money is on the line. Sixth, you must define your position sizing methodology. How much of a currency do you actually buy or sell? This connects directly back to your risk management. Your plan should have the exact formula. It typically looks something like this. You take the percentage of your account you're willing to risk, say that 1%, and you divide it by your stop loss distance in pips. This calculation gives you the proper lot size for that specific trade, ensuring that if your stop loss is hit, you only lose the amount you predetermined. This is how professionals manage risk on every single trade. Finally, your trading plan must include a commitment to record keeping. Every trade you take should be logged in a journal. The entry price, the exit price, the reason for the trade, the profit or loss, and crucially, how you felt during the trade. Were you anxious? Greedy? Confident? This journal is your feedback loop. At the end of every week and every month, you review your journal. You identify what worked and what didn't. You see if you followed your plan. This process of review and refinement is how you grow as a trader. Your trading plan isn't a static document you write once and forget. It's a living blueprint that you improve over time based on hard data from your own performance. Putting it all together, A trading plan is your shield against the psychological warfare of the market. It prevents you from making impulsive decisions in the heat of the moment. When the market is soaring and you feel the fear of missing out, your plan tells you if the entry criteria are met. If not, you do nothing. When a trade goes against you and you feel the urge to move your stop loss just a little bit further, your plan screams no. It is the voice of your rational, well-rested, analytical self, guiding your emotional, in-the-moment self. Executing your plan with unwavering discipline is the true secret to longevity in this business. Without it, you're just gambling. With it, you are operating a professional business. Now that you have the blueprint, the very architecture of your approach, the next step is to get the tools and find the right place to build. It's time to navigate the world of brokers and platforms, the digital arenas where these plans are put into action. Now that you have the blueprint, the very architecture of your approach, the next step is to get the tools and find the right place to build. It's time to navigate the world of brokers and platforms, the digital arenas where these plans are put into action. Think of a Forex broker as the essential bridge connecting you, the retail trader, to the vast interbank currency market. You can't just walk up to a major bank and ask to trade €1,000,000. You need an intermediary, a licensed and regulated entity that provides you with the technology, the access, and the liquidity to participate. Your broker is your gateway, and choosing the right one, well, it's arguably one of the most critical decisions you will ever make in your trading journey. It's like choosing your climbing partner for an ascent up Everest. A good one can be a lifesaver. A bad one can be the reason the entire expedition fails before you even reach base camp. Your meticulously crafted strategy, your ironclad risk management plan, they can all be undermined by a poor choice of broker. So, how do we find the right partner? For traders in the United States, the landscape is unique, and the first filter, the absolute non-negotiable, is regulation. This isn't just a suggestion. It's the bedrock of your security. The US has one of the most stringent regulatory environments for Forex in the world, and that's a good thing for you. The two organizations you need to have burned into your memory are the CFTC, the Commodity Futures Trading Commission, and the NFA, the National Futures Association. If a broker wants to legally offer Forex trading services to US residents, they must be registered with the CFTC and be a member of the NFA. There are no exceptions. This isn't just bureaucratic red tape. It's your armor. These regulations enforce strict capital requirements, ensuring the broker is financially stable. They mandate transparent pricing and fair business practices. Most importantly, they provide a system of oversight and accountability. You might see ads for offshore brokers promising incredible bonuses or unbelievably high leverage. Run. Don't walk. These entities operate outside of US jurisdiction, meaning if something goes wrong, if they refuse a withdrawal, manipulate prices, or simply vanish with your funds, you have virtually no legal recourse. Sticking with a CFTC and NFA-regulated broker is the first and most important step in protecting your capital. This strict regulatory environment also leads to another key difference for American traders: leverage. While traders in other parts of the world might see leverage of 500 to 1 or even 1,000 to 1, the NFA has capped leverage for US retail clients. It's 50 to 1 for major currency pairs like the Euro/US dollar and 20 to 1 for minor pairs. Now, a newcomer might see this as a disadvantage, a limitation, but experienced traders often see it for what it is: a crucial safety mechanism. Extreme leverage is a double-edged sword that magnifies losses just as quickly as it magnifies gains. The NFA's leverage cap is like a guardrail on a treacherous mountain pass. It might feel like it's slowing you down, but its real purpose is to stop you from flying off the edge. It forces a more disciplined approach to risk management from day one. Once you've filtered your search to only NFA-regulated brokers, the next major consideration is the trading platform itself. This is your command center. It's the cockpit from which you'll analyze the market, place your trades, and manage your positions. It needs to be stable, reliable, and intuitive. A platform that freezes during a major news release or has slow execution can be the difference between a calculated entry and a costly mistake. The industry standard for many years has been MetaTrader 4, or MT4, and its successor MetaTrader 5. They are incredibly popular for a reason. They're robust, offer powerful charting capabilities, and support a massive ecosystem of custom indicators and automated trading programs known as expert advisors, or EAs. Many brokers offer MT4 or MT5 as their primary platform. However, many top-tier brokers have also invested heavily in developing their own proprietary platforms. These can offer advantages like a more modern user interface, integrated research and news feeds, and more advanced order types, all seamlessly built into one ecosystem. There's no single best platform. It's a matter of personal preference. Does it feel intuitive to you? Is the information you need clear and accessible? Can you execute trades quickly and efficiently? The only way to know is to test them. And that brings us to the cost of doing business, spreads and commissions. This is how brokers make their money. The spread is the tiny difference between the buy price, the ask, and the sell price, the bid, of a currency pair. You'll always buy slightly higher and sell slightly lower, and that difference goes to the broker. Some brokers offer commission-free trading, where their only compensation is built into a wider spread. Other brokers, particularly those using an ECN or electronic communication network model, offer razor-thin spreads but charge a fixed commission for every trade you place. An ECN model essentially passes your order directly to a network of liquidity providers, like major banks, creating a more transparent pricing environment. The key is to understand the total transaction cost. Don't be swayed by zero commission if the spreads are consistently wide. Conversely, don't be scared of a commission if it comes with incredibly tight spreads. Look at the all-in costs for the currency pairs you plan to trade. Beyond the technology and the costs, consider the human element, customer support. This is the factor everyone ignores until they desperately need it. What happens when you have a technical issue with a live trade open? What if you have a question about a withdrawal? You need access to competent, responsive support. Before you even think about funding an account, test their support. Use their live chat. Send them an email. Call their support line. Ask a few basic questions about their platform or account types. Their response time and the quality of their answer will tell you a lot about the company you're considering partnering with. Finally, look at the logistics of money, deposits and withdrawals. Getting money into an account is almost always easy. The real test of a broker's integrity is how easy it is to get your money out. Check their available methods. For U.S. clients, look for easy options like ACH transfers, bank wires, and debit cards. Investigate their withdrawal policy. Are there fees? How long does it typically take to process? A reputable broker will make this process transparent and straightforward. Any unnecessary delays or complicated procedures are a major red flag. The best way to put all these pieces together is to take a test drive. And in the world of Forex, that test drive is called a demo account. Never, ever deposit real money with a broker until you have spent significant time on their demo platform. This is your free, risk-free flight simulator. Use it to check the stability of their platform, see what their spreads look like in real time, especially during volatile market news. Practice placing and managing trades to get comfortable with the software. Test their mobile app. This hands-on experience is invaluable. It allows you to vet the broker and their technology while simultaneously honing your own trading skills without risking a single dollar. Choosing your broker and platform isn't a task to be rushed. It's a foundational decision that sets the stage for everything that follows. You've got the strategy, the blueprint for what you want to build. Now you're choosing the workshop and the quality of the tools you'll use. You've ensured your workshop is safe and secure by focusing on U.S. regulation. You've inspected the machinery, the platform, and you've calculated the operational costs. But once all of that is in place, the plan, the tools, the secure location, there's one final crucial element that determines whether the structure you build stands tall or crumbles under pressure. It's the most overlooked, yet most powerful factor in any trader's journey. It's not about the charts or the broker. It's about the person staring at the screen. It is time to address the trader's mindset, the psychology that separates fleeting attempts from long-term discipline. This internal battlefield is where the real war for consistency is won or lost. You can have the world's best strategy, the fastest internet connection, and the most sophisticated charting software. But if you haven't mastered your own mind, you are bringing a knife to a gunfight you started with yourself. Let's dissect the two titans of emotional trading that every single person who looks at a chart will face: fear and greed. They are two sides of the same coin, and they are responsible for the vast majority of blown accounts. First, fear. Fear manifests in several ways. There's the fear of missing out, often called FOMO. You see a currency pair like the euro versus the dollar suddenly rocketing upwards. You didn't have a setup, it doesn't meet your criteria. But you see the green candles stacking up and think, I have to get in on this. So you jump in, buying near the top just as the early disciplined traders are taking their profits. The market reverses and you're left holding a losing position, born not from analysis, but from a primal fear of being left behind. Then there's the fear of losing. This might sound rational, but it's paralyzing. It causes you to hesitate on a perfect trade setup that meets all your rules. You second-guess yourself, wait for more confirmation, and by the time you build up the courage to click the button, the ideal entry point has vanished. Or worse, it causes you to close a winning trade prematurely. Your plan might have a profit target of 50 pips, but at 15 pips, the fear of the market turning around and taking back your small profit becomes so overwhelming that you close the trade, leaving significant potential on the table. The flip side of this coin is greed. Greed is the siren song of the market. It's that little voice that whispers, "This is the one. Go all in." Greed is what makes a trader, after a few successful trades, double or triple their position size, abandoning their risk management rules. They believe they've figured it out and can't lose. This overconfidence leads to over-leveraging, where a single loss doesn't just erase the previous wins, but can cripple an entire account. Greed also prevents traders from taking logical profits. A trade hits its target, a perfectly reasonable place to exit based on analysis. But greed says, maybe it'll go higher. So you hold on, watching as the trade not only returns to your entry point but plummets into a significant loss. One greedy decision can undo the progress of dozens of disciplined, well-executed trades. These two emotions often work in a devastating tandem. Imagine you suffer a loss because you were greedy and held a trade too long. Now anger and frustration set in. You feel the market owes you one. This leads to the most destructive behavior of all: revenge trading. You immediately jump back into the market, taking a random unplanned trade, often with a larger size, just to make your money back. This is not trading. It's gambling with a vengeance. It's like trying to put out a fire with gasoline. It almost never ends well and is the fastest way to zero out an account. So, how do you combat these deeply ingrained human emotions? You can't eliminate them. You're human, but you can manage them. You build a system of logic and discipline that acts as a fortress against emotional impulses. The first pillar of this fortress is your trading plan. We've talked about this before, but its psychological importance cannot be overstated. Your trading plan is you, at your most rational and objective, making decisions for your future emotional self. It is written down when the markets are closed, when you are calm and can think clearly. When the market is open and your money is on the line, your job is not to think, not to feel, not to predict. Your one and only job is to execute the plan. Your plan says, if A and B happen, I will do C. When A and B happen, you do C without hesitation, without question. The plan is your boss and you are the employee. The second pillar is an unwavering commitment to risk management. Deciding before you ever enter a trade how much you are willing to lose is the ultimate act of emotional control. By setting a stop loss on every single trade, you have quantified your maximum pain. You have accepted the risk. This acceptance is liberating. A loss is no longer a catastrophic personal failure. It's a predefined business expense, a calculated cost of finding out if your trade idea was correct. Professional traders think in terms of risk and probabilities, not in terms of being right or wrong. The third pillar is patience. The market doesn't care about your schedule or your need to make money today. There will be days, even weeks, where no setups matching your plan appear. The amateur feels the need to be constantly busy, to always be in a trade. The professional understands that they are paid to wait. They are like a sniper waiting patiently for hours or days for that one high-probability shot. The majority of your time should be spent analyzing and waiting, not trading. To reinforce all of this, the single most powerful tool for psychological improvement is a trading journal. This is not just a log of your wins and losses. It's a diary of your mental state. For every trade, you should write down why you took it, what your expectations were, and crucially, how you felt. When you review your journal, you'll start to see patterns. I see that every time I lose 3 trades in a row, my 4th trade is always an oversized, impulsive revenge trade. Or, I notice that I consistently cut my winners short on Fridays out of fear of holding over the weekend. You cannot fix a problem you are not aware of. The journal is your mirror. It shows you the trader you are, not the trader you think you are. This entire journey, from understanding what a pip is to managing the complexities of your own mind, is not a sprint. It is a marathon. Learning to trade Forex is much like learning any other elite professional skill. It takes time, dedicated practice, and a brutal commitment to self-analysis and improvement. The market is one of the most competitive arenas in the world. You are competing against brilliant minds, sophisticated algorithms, and massive institutions. But your primary competitor will always be the person you see in the mirror. As we conclude this series, I want you to reframe your perspective. Don't view Forex as a magic money machine. View it as a business you are starting. A business requires a plan, capital, risk management, and a CEO who can remain disciplined and objective under pressure. Your demo account is your business incubator. It's where you test your plan, make mistakes for free, and learn to control your emotions without financial consequence. The path of a trader is a path of continuous learning. This series was designed to give you a foundational map, to show you the terrain, point out the major landmarks, and warn you about the common pitfalls. But your journey of exploration has just begun. Continue to educate yourself. Many traders find immense value in reading classic books on market psychology and technical analysis. They follow reputable financial news to understand the fundamental drivers of currency movements. They find communities of other disciplined traders to share ideas and maintain perspective. The challenge is immense, but it is also what draws people to the markets. It is a profound puzzle of logic, strategy, and self-control. For those who approach it with respect, with discipline, and with a commitment to lifelong learning, it can be an incredibly rewarding endeavor, not just financially, but in the self-mastery it demands. Your success will not be defined by any single trade, but by your discipline over thousands of them. It will be defined not by a chart pattern, but by your own patterns of behavior. Thank you for joining me on this introductory journey. The next step is yours to take. Trade with discipline, manage your risk, and never stop learning.